Among these sellers, two distinct groups stand out: Middle East oil exporters, Saudi Arabia, United Arab Emirates, Egypt, and East Asian countries, China, Hong Kong, Singapore, Thailand. The former group of countries benefited from historically high oil prices in the run-up to the GFC that created large current account surpluses. By contrast, oil exporters suffered in spring 2020, as oil prices collapsed to levels not reached in nearly 20 years and current account surpluses were significantly smaller heading into the COVID-19 crisis compared to the GFC. Additionally, other Middle East oil exporters like Kuwait, Oman, and Qatar also purchased U.S. Treasury securities during the GFC but sold in spring 2020. While the East Asian countries avoided severe financial stress during the GFC through the then limited exposure to securitized products and bank loans, the epicenter of stress, their increased exposure to U.S. dollar funding markets over the past decade and extreme uncertainty surrounding the severity of the COVID-19 shock likely necessitated sales of U.S. Treasury securities, if even just to hold precautionary dollar liquidity. The net sales by foreign private investors in March and April 2020 likely also reflected the extreme severity of the COVID-19 crisis, which created a strong demand for very liquid assets, the so-called dash for cash, rather than a loss of safe haven status for U.S. Treasury securities. Indeed, the turmoil in U.S. Treasury markets was generally concentrated in longer-term Treasury notes and bonds. Consistent with this argument is that foreign private investors continued purchasing U.S. Treasury bills in spring 2020 but sold very large amounts of U.S. Treasury notes and bonds at the same time. This pattern is not unique to the COVID-19 crisis, as foreign private investors also sold U.S. Treasury notes and bonds at the height of the GFC while purchasing U.S. Treasury bills. The reasons why foreign sales of U.S. Treasury notes and bonds were so much larger during the COVID-19 crisis are, in short, the unwind of the Treasury basis trade by hedge funds, including foreign domiciled funds, and the sudden, massive investor outflows from mutual funds that caused these funds to sell their most liquid assets, U.S. Treasury securities, to meet these redemptions. While the share absorbed by foreign investors has fallen in recent years when compared to the period following the GFC, this is not the result of a major shift by foreign investors away from U.S. Treasury securities toward other assets. Instead, it coincides with a leveling off in foreign official holdings of U.S. Treasury securities that is mirrored by a plateau in global foreign exchange reserves. Notably, the U.S. dollar share of foreign exchange reserves has remained around 60% during this time, suggesting no loss of prestige for U.S. Treasury securities, a point echoed for the U.S. dollar more broadly.